Welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor, and as I like to remind you each and every week, I'm also the author of a newsletter, Jay Taylor's Gold, Energy, and Tech Stocks, and my company, Taylor Hard Money Advisors, is in partnership with Chen Lin, who publishes What is Chen Buying? What is Chen Selling? And again, I'll remind you to sign up for my letter or Chen's. You can go to miningstocks.com, and to sign up for either of those letters, or you can also call us during normal work hours in New York City. 718-457-1426 is the number, 718-457-1426. Well, for now, though, let's talk to Michael Oliver, who's with me again. Thanks for joining me again, Michael.
Hi, Jay. Good to be back.
Always good to be back, and it's always good to tell my listeners that they really owe it to themselves to go to olivermsa.com, olivermsa.com, to learn more about Michael Oliver's work. Michael, you've been talking about gold moving around for a while in a congestive pattern. The last couple of weeks or so, that's been the terminology you used. What is your momentum work suggesting is a price level that could trigger a substantial move higher? What sort of resistance levels is your momentum work suggesting we need to get through in order to see much higher prices? I think you're looking at $1,450 as sort of a first stop in the next major move.
Yeah, first off, context. The long-term momentum factors of gold, annual and quarterly momentum as I measure them, which is different than looking at price, broke out between 1140 and 1160 area during the month of February. And immediately upon breaking through that zone in price, which doesn't mean anything on a price chart, but for momentum it was a major breakout. We surged $100, went to 1260. That was like the second week of February, which was coincidental with the S&P low. Okay. Now, the S&P's had one heck of a percent rally, but gold has not had one heck of a percent decline. It's congested. In fact, right now we're in the 1240s. I think that's actually higher than the peak close of that surging week in the second week of February. Mm-hmm. So we're basically really in about an $80 range or a little less in gold, up and down for the last 7 weeks. And I call it a congestion zone. In other words, that surge that we had after the breakout got gold into a temporarily overbought situation. And there's two ways to correct that. One is to go down hard, and the other is just to waste your time. And it's largely been a waste of time, I think, for anybody to try to short it unless they're real quick. So I view it as a congested phase. I still think we're going higher. We're crossing some numbers today on the settlement that argue that maybe you're ready to return to the high, but it's not all that. It's a very near-term situation there. But the big picture says up. We already have 17% on the year right now, and we're off the highs, whereas the S&P is floundering around unchanged on the year, so take your pick. And the dollar is the other interesting situation. I've been watching it closely in layers because, the dollar index, which is the barometer of the dollar, is comprised of various trade-weighted currencies. The euro is by far the largest. It's 57% of the dollar index. So the euro, while it's been trapped off of its lows, but in a congestion zone for the last 4 or 5 months, I guess, it has not played the game either way. And that's helped the dollar remain relatively steady, though slightly weak, but not sharply weak. The yen, meanwhile, which is the second heaviest weighted currency in the dollar index, I think it's like 17% or something, has surged dramatically since the close of last year, and is chafing at the bit to gain more. Also, in that package is the Canadian dollar and the British pound. The Canadian dollar, as far as I'm concerned, is breaking out big time this month on long-term momentum. That tends to confirm the gold situation and a potential commodity bottom, because this currency does tend to move with commodity baskets. And the BP has been oversold, and it's turning up enough this month for it to look at least intermediate positive, meaning for the next 3 to 4 months, I'd expect it to rise. So we're starting to see a situation here with the euro even today firming nicely. And it's not really at my breakout levels, which is above 114. It's in the 113s, but its persistence suggests to me that it wants to go higher, wants to go up into the 120s again. Now, if you put all that package together, that could really put the dollar index into some trouble. It's toying right now with 95 level, the dollar index cash today. And if you close out the month at 95 and especially 94.50, we've been down close to that level this quarter, intra-quarter. That indicates to me it wants to go down into the high 80s. That's a significant move, considering that its peak was over 100. I think at that point you're back in a bear market in the dollar. If you close out this month or this quarter at the 94.50, for example, I think that will open up a downdraft of some significance for that currency, and that obviously will help gold and laggard commodities.
Mm-hmm. How about the stock market?
Oh, I think the rally is a lot of hot air. I think they're excited today because what Yellen said or implied or didn't say, it was all the things they wanted. But meanwhile, look at what really gained today. T-bonds, which have been negative to the S&P, gold, the euro, dollar index went down. The spread between TLT, which is the safe government debt instrument, 20-year and onward in maturity, versus the HYG, which is the high-yield debt instrument, that spread favored the TLT today. So in other words, there's still a flight to safety here in the debt markets, away from high yield into low yield, low risk. So all the peripheral markets around the S&P are saying something opposite today to what the S&P is saying. And I think that's important.
Wow. Well, certainly one of the markets, the most important markets, if not the most important market in the world, is the markets for U.S. Treasuries. We're still in a bull market, aren't we? We're still in a secular bull market for U.S. Treasuries.
No, my numbers have not been broken. They started the year around them and immediately went up, and I'll adjust. I do think by late this year, probably you're going to have T-bonds yields starting to rise and the price coming back down. In other words, the long end of the debt market will turn the other way. And at that point, the inverse relationship, I think, between the long-term safe debt, German debt, our debt, for example, which has been trending to lower yields, will shift toward higher yields, and that will hurt the stock market.
Well, that would seem to me to portend of a loss of confidence in the fiat money system globally. If we're starting to see the strongest currencies and the strongest treasury debt markets start to decline in value, yields rise, markets decline, that would not be a happy sign for.
Well, I think that Yellen and her predecessors have paved the road for. They wanted 2%. Draghi wants 2%. Everybody wants 2% inflation, as if they can control it. What I see in commodities being led by gold now, but later on this year, I think you'll see it in commodities. It's not going to be 2%. It's going to be a lot more, and I think that will shock some markets, especially the long-term end of the debt market.
Mm-hmm. Well, certainly we know from the past, Michael, and we're just about out of time here, but we know from the past that once you start having some inflation issues, that it can really start to run very rapidly and get out of hand. That would seem to be something that could happen if the dollar starts to lose its value. It's really a con game, isn't it? I mean, it's all about a con game.
Oh, it is. Fiat money is a loss of the capability of man to measure something.
Right.
It's so unreal in terms of its measurement. If you had a yardstick that changed its size every other month or so and increased in size but still said 36 inches, it's like a dollar bill says $1, and yet its real size changed on you, you can't rely on it as a unit of measure. Well, in the economic and financial world, what do we rely upon as unit of measure of reality? Changing fiat currencies that double their quantity every 10, 12 years.
Right.
Well, hardly a reliable yardstick.
As my good late friend Ian McAvity used to say, a barrel of oil is a barrel of oil, an ounce of gold is an ounce of gold. What is the dollar? And as you point out, there's no measurement for it. We do. That's why we encourage listeners to think about taking some of those fiat dollars and putting them into tangible assets, starting with the most liquid of all, gold, silver, some things like that. Michael, we're out of time. Thanks for your insights. Always good to talk to you. Always good to hear what you have to say. No reason to get bearish on gold then at this point, I guess. We really want to...
not. Stay happy.
All right. Very good. Well, thanks so much, Michael. Thanks for being with us. We'll look to do it again next week.